As investors continue to navigate a market upswing, growth stocks are gaining traction, with the S&P 500 index rising over 10% in the past month alone. This surge is largely attributed to increased optimism surrounding corporate earnings and economic expansion. Key catalysts driving this trend include robust quarterly results from major tech players like Alphabet and Amazon, which have led to renewed confidence among investors. For instance, Alphabet's Q2 revenue surged 22% year over year to $40.5 billion, dollars, while Amazon's Q2 net sales increased 20% year over year to $113.1 billion. dollars. Additionally, the Federal Reserve's decision to maintain accommodative monetary policies has provided a supportive environment for growth stocks. The latest GDP data also indicates a 2.1% annualized increase in economic output, further bolstering investor sentiment. Furthermore, the International Monetary Fund (IMF) has revised its global growth forecast upward, citing improved economic conditions and increased business investment. Data points from recent market trends reveal that growth oriented sectors such as healthcare and technology are outperforming their value counterparts. For instance, the Nasdaq Composite Index has surged over 15% year to date, outpacing the S&P 500's 12% gain during the same period. The biotechnology sector in particular has seen significant gains, with companies like Biogen, BIB, and Gilead Sciences, Guild, experiencing notable stock price appreciation. A rise in merger and acquisition activity within these sectors suggests that investors remain bullish on growth prospects. For example, a recent deal between Bristol Myers Squibb and Celgene has sparked increased investor interest in the pharmaceutical sector. However, risks associated with this market upswing cannot be ignored. Rising inflation concerns and a strengthening US dollar may curb investor enthusiasm for high growth stocks. Moreover, potential economic slowdowns or unforeseen regulatory changes could significantly alter the landscape. For instance, a recent study by the McKinsey Global Institute found that 40% of companies in the S&P 500 index have increased their debt levels in response to low interest rates. In light of these factors, tactical ideas for investors include targeting key resistance levels around 4,200 on the S&P 500 index, with a focus on growth-oriented sectors such as healthcare and technology. A breakout above this level could potentially signal sustained momentum for these stocks. Investors may also consider dollar cost averaging strategies to mitigate potential market volatility. Takeaway: growth stocks are regaining traction in an upswing market driven by robust corporate earnings and economic optimism. While risks persist, investors can take a strategic approach to capitalize on growth prospects.